Hey, everybody, we're live. It's always a little getting ready, mentally prepared to go live. It is great to see you. Welcome to a new episode of Be the Boss of Your Money. We are about investing, stocks, bonds, you name it. We're about personal finance. We're about business. I want nothing more than to convey great value to you. I'm Mitch Goldberg, if we haven't met yet. I'm a financial advisor with 30 years of experience. Believe me when I tell you, I've seen a lot, and I'm going to share it with you. Today is a special show because we have so much to cover in the 20 minutes that I have allotted to this show. So if you're watching from Facebook, LinkedIn, welcome to you. If you're in the live stream, I would love to see your comments, words of encouragement. If you're watching this from YouTube, I want to apologize in advance. At this time, I cannot accept comments through YouTube, but you can reach out to me directly. I always put my email address in the description of my YouTube videos, so reach out to me. I would love to connect with you as well. And if you're watching this in the replay, I'd like to welcome you as well. And if you have any questions in the replay, certainly ask, and I will get back to you because I check up on these things. So we're going to talk about a couple of things, but I think the one we have to start with is we've had the third week in a row of a horrendous first-time unemployment claims. And it's the third time in a row that the stock market went up on the most horrendous news. We're going to talk about why, what people think. So without further ado, let's roll the intro, and we're going to have a really informative show. And we're going to talk about picking stocks. Okay, everybody, welcome to all of you. Welcome to Be the Boss of Your Money. We've got a few things to talk about here. Important stuff. I always want you to, I want you to be better off after you watch this than you were before. The idea is to make you your best possible version of your financial self, right? That's what this is about. Let's get into it. So, what's the deal with the market going up? Okay, this is every Thursday we receive our non-farm unemployment claims, first-time unemployment claims. So we're up to about, 17 million job losses in the last few weeks. And the job losses, just the suddenness, how quickly they happened. So far, I haven't seen any slowdown because of the payroll protection program. But then again, that's probably because so few business owners are as of yet receiving money from that. I know I put my business's application in, and you have no idea if you did it right or not. You just you get a confirmation from the bank that you entered everything, and that's the end of it. And maybe I'll find out. But you can't find anything out about it. It's kind of frustrating. So third week in a row, we had like 3.5 million unemployment claims and 6.4 million or so last week. Today, 5.25 million first-time unemployment claims. 5.25 million people who lost their jobs, who filed for unemployment. Those are staggering numbers. I mean, just incredible numbers. And yet the market went up today. This is a third week in a row we have staggering unemployment numbers, and staggeringly, the third time in a row the stock market went up. And if you watch us yesterday, I talked about how retail sales figures, they just plunged, worst time since we've been keeping track of those numbers since the early 90s. Home builder confidence plunged, new home construction plunged. Well, everything that has to do with commercial, with residential real estate has plunged. The New York State Manufacturing Index plunged. You could basically see anything and follow it up with the word plunged, because that's what we've been going through. That's what happens when you shut down the economy. So, and yet the market's been holding up. Now, the low so far in this recession/bear market was March 23rd. So next Monday will be 4 weeks. What I'm thinking is, from my perspective, is that with so much bad news out, the market's holding up pretty well. I mean, if you take a look at the year-to-date moves on the major averages, mean, we're down, a little bit more than double, maybe 14, 15%, which depending on which index you look at. By the way, you cannot invest directly into an index, but you could invest in a security that mimics a traction index. But we're not down that much, especially after the year that we had last year. So what gives? Look, I think we need to talk about why stocks can go up, why the stock market would go up on a pretty tough day of economic news. And that's because people have already become accustomed to worst case scenarios. People have already factored really bad economic stats into their numbers. I'm talking about investors. So when you get a really bad number, people have already done their selling. Okay. Investors have already done their selling ahead of those numbers so that by the time the number comes out, it's kind of like selling the rumor, buying the news. Used to be the other way around, but that's the way it works now. So that's why there's no more sellers and people go, oh, you know what? It's not that bad. We're getting through this stuff and we come back. I think the other reason why we're able to hold up today is because I don't know if you saw this, but the northeastern states, New York, are now expanding their social distancing, school closing, et cetera, to May 15th. I actually think that's good. Now, I hate what it does to the economy, but it's that really tough medicine, that we need to get through this coronavirus crisis. If we have people going back to work too soon, it comes back, we have a rebound, it spreads, and then we have to start the whole lockdown thing again. So if we can extend it for 2 more weeks or 15 more days, that is, I think, a good thing. I think the more draconian the measures, the faster we get through it and the faster the economy can come back. So anyway, that's why stocks today rallied, even in the face of lousy bank earnings yesterday, and companies that are reporting earnings are coming out consistently and saying, we're withdrawing our visibility for our forecast for the rest of the year. We have limited visibility, no visibility. Wall Street, investors, we hate that kind of uncertainty. But stocks are getting the benefit of the doubt because it looks like we're getting through this, and the bad news has already been largely factored in. How else could you explain the 3 major averages being up today? Okay, granted, there were some big moves in tech stocks. We're going to take a look at Amazon in a moment, which hit a new year high yesterday. Wait till you see what it did today. Okay, so market keeps rallying back after horrendous figures. 3rd week in a row, lousy unemployment. 3rd week in a row, stocks reacted by going up. Okay, so we spoke about Cuomo. Now, we have to say one of the main things about this episode here is for buying stocks, if you're an investor, a lot of people are asking, well, maybe, if we got through the worst part of this and we know the stimulus is going to help, it will, the Fed stimulus, the stimulus act from the CARES Act, the payroll protection, the EIDL, all of these programs, they'll work, they'll help. Nothing can take away the pain and suffering of this coronavirus, but those will help the economy, they'll help markets. Do you buy stocks that are the quote unquote coronavirus stocks? Like if I had to open up a new ETF, an exchange traded fund called the coronavirus ETF, it would have the first stock would probably be Zoom, right? Zoom for video conferencing, then Clorox, then maybe Activision Blizzard, video games, Take-Two Interactive. Maybe it would be Amazon, Microsoft, very big component of technology. Okay, but these stocks are already up. Some of them are up a lot this year. So let's just do a quick share screen because I need to illustrate a point in terms of what to buy. We talk about individual stocks. Not that these are recommendations to you. I'm just saying as examples. But I'm going to show you stuff that no one else is going to show you. Okay, I pride myself on being unique. So you see the major averages all in the green. Small caps lagging a little bit, but you see the VIX down to 40. This is like 45 at its high yesterday, or 44. So VIX is coming down a little bit. But if you take a look at Zoom, okay, Zoom was off a touch today, but year to date, stock is up. Okay, right in the middle of the screen over here. See where my cursor is? 120% year to date. Amazon, and I'll say, Amazon is a important stock to me and to my clientele. So that's a big one for us. And Amazon is up 30% year to date. Costco is another one that is an important stock in my world, and that is up 9.4%. Okay. So do you keep buying these same stocks? Do you want to buy the same stocks, or do you want to look at stocks that are counter to this? So there's something called growth versus cyclical, and growth stocks are companies that grow basically no matter what. They have secular growth regardless of economic cycles. Now, Zoom, you could say, is really just a result of the coronavirus, everybody working from home, everybody using Zoom. And it's amazing how well Zoom works. I was on a call last night with about 40 people, a Zoom conference, and it was amazing how well the technology, how robust the technology is. So that was incredible. But you could take a look at an Amazon, and you could take a look at a Microsoft, you could take a look at Costco. These companies were doing well before this whole crisis started. So do you keep going into those, or do you buy the beaten down names? The most beaten down names are energy, airlines, and cruises like Royal Caribbean and Carnival. Maybe that's a little over the top in terms of risk for a lot of people, but you have a lot of deep cyclical names that require a stronger economy to grow their earnings. And those are the kinds of stocks, when I think of cyclical, I'm thinking of Honeywell, John Deere, Caterpillar, also known as smokestack stocks. So which ones do you buy? Do you chase the ones that have already gone up? Or do you shift and go into the ones that haven't recovered yet, but you think are the next ones to go up? That really is what you have to decide. It used to be growth stocks were strictly, growth stocks were drug stocks and consumer staples. But I think, and technology used to be more cyclical, but now I think it's really, I would say it's more of a growth sector as opposed to just a cyclical name. Okay. Cyclical group. My best answer is you still need to do both. You still need to diversify. Diversification, it's a compromise. Diversification, you don't diversify because you think you're going to do better, because you think it's going to juice your returns. You diversify because it helps prevent you from making your worst mistakes. Okay. It helps you, lose less. It's supposed to help you lose less in a down market. Now, diversification is a strategy that we use, to reduce risk. But as you can tell in this market, diversification doesn't necessarily protect your portfolio from going down in a generally down market, but it does help. It helps you in a lot of ways. And my sense, though, is you want growth, you want cyclical. I think they both have a place. I would want to say, when I look at a stock now, I'm looking at 6 months, 12 months, a year, 2 years, 3 years, 5 years, and even more. Okay. I want a stock that has an opportunity to, stop sharing screen. Okay. I want a stock that can do well when we come out of this. So that's what I want to look at. But I don't want to abandon stocks that have already done well, because some of them, they've become companies that you just can't live without. I don't think there's any company in the world that speaks more to can't live without than Amazon. How many of us have Amazon Prime? We're all living on it. Okay. So that is the difference. So when if we're going to chase the same stocks that are going up now, or shift some money into the stocks that haven't moved yet, but we expect will do well when we come out of this cycle, this nasty cycle we're in, I think you need both. Okay. Now we could go into individual names, but if you want to do that, you really have to give me a call, because I don't want to just start touting all kinds of stocks on the live stream. Okay. So what will life be like? Are we going to stop Zoom calling after this? By the way, folks, if you have your own thoughts, your own views about this, let me know. You have questions, let me know in the comments. I'm going to check who's out there as we go along with this. Jerry, I see you are out there. Thank you so much. Let me put you out there. Hey, Mitch, love your show. Are we going to retest the lows? I'm been saying on this live stream, so I'm on record for saying no. If I'm wrong, I'm wrong. It doesn't really change how I invest for clients because it's always about your risk tolerance, your time horizon. And I just want to bring up something else. You remember, Jerry, we had spoken about a video I made probably about a year and a half ago, why I don't like. I remember I made a video, 3 kinds of stocks I don't like. One of those 3 things was companies that are at a year low. And you could see, I gave you a couple of examples, but the 2 examples I gave in that video were Ford and GE. And they're down substantially since hitting year lows. And I also don't like stocks with low PE ratios. A stock with a low PE ratio tells you that investors have made their judgment that there's no growth where the company's going backwards. And I remember we talked about Apple, and Apple had subsequent to that had hit a new low. We talked about that through Facebook. And Apple, I don't say never buy a stock ever if it hit a low. No, never buy it. But I like to give them a little time to see if they can recover a little bit. Show me some good news. Show me the money. Show me a turnaround with the company's fortunes so I can feel comfortable buying it. I'm not saying I need a stock to go all the way back up to its old high. I'd rather buy a stock at a high than a stock at a low, I'll tell you that. But so it doesn't mean never buy a stock that hit a low. It just means that I would rather wait and see what the problem is, because maybe the problem isn't real. Maybe it's just a worry that turns out to be unfounded. Okay, so anyway, for a number of reasons, I think we already hit the bottom. I don't think we do a retest. If we do, I'll be the first person to admit, hey, you know what, we're retesting, sorry. But I'm not making, all or nothing drastic stock moves just based on if we hit a bottom or not. I think it's fun to talk about these things, okay? So that is that. Now, what's going to be different when we get out of this coronavirus world that we're living in? Well, one thing I think in my business, for people who have to earn CE, continuing edu credits, things like that, I think it's almost all going to be on Zoom. I really don't see a reason why I would ever go to like a seminar for that again when it's just for CE credits or something like that. So that's one thing. The education world, I think, is permanently altered. There have always been online colleges, but as the quote unquote legitimate colleges, not the Apollos of the world, but the legitimate colleges, not Trump University. Oh, did I say that? Look, that did not go too well. So I'm saying it. I think when you see the legitimate colleges like Penn State, some of the really good state colleges around the country, a lot of the private schools, they're all using it. They're all testing out video conferencing, and maybe they can educate a lot more people for a lot less money. So they might not get the full $60,000 a year from a student who lives on campus, but maybe they could, make that up in volume, and it's going to be really competitive. But I think Zoom is very effective, or video conferencing, whatever service you use, is very effective. Commercial real estate. I've spoken with a number of business owners, including the, I use Next Financial Group as my broker dealer. And I've spoken to a lot of people out, in the business world, and they're all saying the same thing. You know what? We have to look into reducing our real estate footprint, because, now that people are able, you realize how well people can work from home and how much can get done. What do you need all the real estate for? Maybe you need people to come into the office once a week to do check-ins. There are ways to adjust to accountability. Okay. But I think it's a great thing. I'm working from home right now. This is my 4th straight week of working from home. This is not necessarily, for people who have a home office. That's an office that's in your home. I'm talking about working remotely. I think there's a subtle difference there, but I find it to be very comfortable for me to work from home. So I think it's really good. How do you think real estate or other things in the business world are going to change? I still look forward to getting together with people at my networking events and going to fun functions and all that. So I don't want everything to go online, but a lot of the things I'm doing and a lot of the meetings I'm having with people and my networking groups, a lot of this is shifting to Zoom conferences. I happen to be very comfortable with that, and are we going to go back to shaking hands in 6 months? Are we going to be going to events where like there's 1,000 people in a ballroom at a hotel crowded in for a big event? Are we going to still do that? Look, we'll get back to those things, but I just wonder if we're going to do that stuff as much. Look, there's nothing like getting together with your business associates for a happy hour or something like that. Okay. So, well, hey, Mike Mosscrop is out there, an attorney. Thank you, Mike, for joining me. I greatly appreciate that. I'm going to check my LinkedIn in a moment also. Okay, so let's see who's out there in the LinkedIn. And then I want to hear what your opinion is of what the world's going to, what the world is going to look like when, all of you are out of this. When do we get back to business? That's what I'd like to know. What do you think? Tell me your opinion. Look, if you're watching this, by the way, and you're getting value out of this, I appreciate so much that you're out there. A lot of people have been telling me, hey, I watch your show. I enjoy it. It's really good. That means a lot to me. So let me have the encouragement, and I'll keep doing this, and I'll find more ways to bring you value. Okay, so a few other things I want to get into. There is a share screen here, companies that have raised their dividend. We're up to the 21-minute mark already, so I'll make this pretty quickly. But an article I just happen to have read on CNBC. When the screen pops up, I'll share it with you. I'm not going to just sit here and make you wait for it. Okay, there, it just popped up. Share screen. Here we go. I don't know if you could see this, but Colgate, Costco, that's a big one for me. Johnson & Johnson, that's a big one for me. Procter & Gamble. So there are companies that are raising dividends, although this cycle has been noteworthy for the companies that are cutting their dividends, but there's still companies out there that are actually raising dividends. So the last thing I want to talk about is James Gorman. I don't know if that name sounds familiar to you. James Gorman is the CEO of Morgan Stanley. And he was interviewed today on CNBC. He was infected with coronavirus, but he came out of it pretty good. And he's fortunate he didn't really have the horrible issues with it, and he was able to just get better at home. But I want to put up what he said, because his opinion, and I've been sharing with you with Klovanovic from Subramanian, from Klovanovic from JP Morgan, Subramanian from Bank of America, David Kostin from Goldman Sachs. I'm just letting you know what some of the big soothsayers are, what they're saying. And, I was saying that we hit a bottom, and now they're all coming out and saying, hey, maybe things aren't so bad. Jim Cramer came around the other day and said, you know what? I was thinking we're going to retest the lows, but now I don't think we're going to retest the lows. But let's see what James Gorman, from CEO of Morgan Stanley, has to say, because he thinks that this recession we're going to be in we're not going to get out of it until the end of 2021. So let's hear it from the horse's mouth. I just want to show you this clip. Take a look real quick.
It's going to take time. So by definition, I think we've got, to get consumers back, to get small businesses back, to get everybody feeling like the world is stable again, that's going to take months. That's not going to take days. So your best case is some sort of U recovery. And I think, if I were a betting man, it's somewhere between a U and I guess an L. I think, it's through the end of next year. We're going to be working through this global recession.
Okay, so you heard what he said. We'll be working through this global recession through the end of the year. That's a pretty big change of pace from what we've been hearing. So now we're not talking for him. We're talking about not just a U. We have like a V-shaped recovery, go into the recession and the bear market deep, come out of it real quick. He's talking about not just a U. He's talking about like a really big valley, like Grand Canyon size, and getting from one end to the other, from one side to the other on foot. I think that's an analogy that's fair to use for this. So even if that is the case, I don't think it's the case for the stock market, because stocks are a different animal. You have companies today that are largely unaffected. And if you look at your biggest companies in the world, you know who they are, the Microsofts of the world, the Amazons of the world. They're not only are they the biggest companies, but their market capitalization, their overall value, talking $1 trillion companies, they kind of crowd out the smaller companies. So since they're the biggest companies and they're the biggest market weightings and the major averages, you might not necessarily see stocks do as badly as the economy. As a matter of fact, I would say the real economy is in much worse shape than the paper economy, the stock market. Some people don't like it, but I don't tell you the way it should be. I tell you the way it is, given your reality. So, hey, James is out there. So I'm going to do a couple of quick shout outs. James Wrigley. Thank you, James. Always good to see you. I guess it's morning for you. James is in Melbourne, Australia. Hey, Lori, great to see you. By the way, Lori, I love your posts, and I would love to speak with you sometime about you being a guest on my show. You put out a lot of really important health and mental health and physical health content, and it's really wonderful what you're putting out. So I get a lot of value out of it. James asks, interested in your views on people who feel they missed the bottom to do something. My opinion, James, it's not too late. We're still down. It's not like everything got back to normal and the stock market's hit a new high. The stocks that have gone up, they've gone up because they're good companies. And we want to buy quality. I don't think quality gets cheap. Quality just goes from expensive to less expensive. And we're quality buyers. There are plenty of cyclical stocks we talked about at the top of the show that could move when we start to see evidence or expectations that the global economy will start to improve. So you want those also. That's what we're talking about, that diversification factor idea before. So that's, I don't think it's too late. And what I would also consider is if you have companies that haven't done well and you've decided after all is said and done, they're really not as good as one thought, you can always sell those and upgrade into companies that have proven themselves to be the survivors today, because the survivors today are going to be the thrivers tomorrow. From survivors to thrivers, like MacGyver. I just made that up. I thought it would sound funny, but it didn't. Jerry agrees. Jerry, let me see that comment from you. Let me see. Agreed. Less large events in the future. People still need to get out and socialize. I think about summer of 2021 for getting back to relatively normal, but never the same as it was. Can't disagree with you, my friend, but we'll see. I hope we have some fun, right? Anyway, we'll get back to that. I want to thank all of you for watching. Again, if you enjoyed this show, and you missed asking a question, let me know in the comments. If you're watching on YouTube, let me know what you're thinking. If you have any questions, through email, and I will speak to you tomorrow. I'll be back tomorrow, 4:30, same time. Thank you so much.